Welcome back, everyone, to the Deep Dive. Ready to decode another real estate mystery with us?
Always.
Well, today we're diving deep into something called yield spread. And to help us crack the code, we're tapping into the wisdom of a true Chicago real estate veteran, Michael Linton.
Now, he's been in the game for 38 years, guiding clients through the ups and downs of the Chicago market.
You can find more of his insights on chicagodealflow.com. But for now, let's pick his brain about this whole yield spread thing.
Sounds like a plan.
So first things first, what exactly are we talking about here? What is yield spread, and how does it factor into real estate investing?
Well, Michael often uses the term cap rate spread, and it's really all about comparing rates of return.
Okay, I'm listening.
On one hand, you have a property's capitalization rate, or cap rate for short.
Right, that's the expected annual rate of return on a real estate investment, considering its net income and market value.
Exactly. Then, on the other hand, you have the current yield on a 10-year U.S. Treasury bond, which is kind of like the gold standard for a risk-free investment.
Backed by the full faith and credit of the U.S. government.
Exactly. And this yield spread, or cap rate spread as Michael calls it, is basically the difference between those two rates. It represents the extra return investors are hoping to get for choosing real estate, which carries more risk than a government bond.
So let's say a property has a cap rate of, 6%, and the 10-year Treasury is yielding, say, 3%. That means the yield spread is 3%.
You got it. That 3% represents the premium investors are seeking for taking on the additional risk of real estate compared to that super safe Treasury bond.
Ah, I see. So it's like a quick and dirty way to assess whether the potential reward justifies the risk you're taking.
Precisely. It distills this complex risk-reward calculation into a single, easy-to-understand number. And Michael says that number can be incredibly revealing, especially in a market as dynamic and diverse as Chicago.
So besides just helping us understand the risk-reward equation, why else is yield spread so crucial for investors, especially those navigating the Chicago market?
Well, Michael points out that yield spread can actually be a powerful indicator of the overall market health. And that's super valuable, especially in Chicago, with its unique mix of neighborhoods and property types.
Okay, so how does yield spread help us take the temperature of the market?
For example, if you start to see a narrowing yield spread, meaning the gap between cap rates and Treasury yields is shrinking.
That could be a signal that the market is getting a little overheated, right?
Yeah. It might mean that real estate prices are getting inflated, or that investors are pouring in despite lower potential returns compared to those bonds.
So a narrowing spread could be like a little yellow flag telling us to proceed with caution, right?
Exactly. It's a sign that things might be getting a bit frothy, and investors need to be extra careful about not overpaying for assets.
Makes sense. So it's not just about evaluating individual properties, it's about understanding those larger market dynamics too.
Precisely. Michael always stresses that being in tune with those market cycles is essential for making smart investment decisions.
Okay, so we've got the theory down. But how does this yield spread analysis actually play out in real-world scenarios? Can you give us some examples?
Definitely. Michael often uses a few key scenarios to illustrate this point. For example, let's say you're considering investing in distressed commercial properties, maybe in a neighborhood that's undergoing a bit of a transformation.
Okay, got it.
Now, if the yield spread in that area is relatively large, it could indicate a really interesting opportunity.
Why is that?
Well, if you can successfully reposition that property and capitalize on that neighborhood upswing, the potential payoff down the road could be pretty significant.
Ah, so a wider spread in an area with some upside potential could mean there's more room for appreciation down the line, even if it comes with more risk.
Exactly. It's about balancing that risk with the potential reward. And yield spread can help you make those judgment calls.
Makes sense. What other real-world examples does Michael use to illustrate the importance of yield spread?
He also talks a lot about covered land plays. These are situations where someone's holding on to a piece of undeveloped land, essentially betting on future development or a rise in land value.
I can see how yield spread would be relevant there.
Exactly. A large yield spread might justify holding on to that land for longer because it suggests the eventual payoff could be substantial, maybe even surpassing other investment options.
So yield spread can help you determine whether it's worth playing the waiting game with a piece of land, even if it means tying up your capital for a longer period.
Precisely. And one more crucial application Michael always highlights is the impact of yield spread on financing decisions. Remember, banks and lenders are in the business of managing risk too, right?
Right. They want to make sure they're getting a decent return for the risk they're taking on.
Exactly. So when they see cap rate spreads over those treasury yields start to narrow, they tend to get a little more cautious.
So they might raise interest rates or require larger down payments, making it tougher to get financing.
Exactly. And that can have a ripple effect on the entire market, impacting property values and investment decisions.
Wow, it's fascinating how this one concept can touch so many different aspects of real estate.
It really highlights how interconnected everything is. And it's a great example of why having a deep understanding of yield spread can give you a real edge in the market.
Absolutely. We've gone from demystifying yield spread to exploring how it plays out in real-world investing. It's clear that this isn't just some abstract number. It's a powerful tool for understanding market dynamics and making smart decisions. But I have a feeling there's still much more to uncover.
Oh, absolutely. And up next, we'll delve into how Michael uses yield spread to not only assess individual properties, but also to gauge the overall market sentiment. Stay tuned for that. It's not just about individual properties, though. Yield spread can also tell us a lot about the overall market sentiment. Michael really stresses that.
Okay, I'm intrigued. So how does he use yield spread to get a sense of where the market's heading, so to speak? What's he looking for?
One of the key things he watches is the direction of the yield spread trend. Is it widening or narrowing? And how quickly is it changing?
So if it's widening, if that gap between cap rates and treasury yields is getting bigger, what's that telling him?
Well, it could mean that investors are feeling pretty bullish on real estate. They're demanding a higher premium for that perceived risk.
So they're thinking real estate has the potential to outperform those safer investments, like bonds.
Right. But it's not always that straightforward.
Oh.
Yeah, sometimes a widening spread can actually be a sign that investors are getting a little nervous about the broader financial markets.
Interesting. So they might be shifting their money into real estate as a kind of safe haven, even if the returns aren't as high as they could be elsewhere.
Exactly. It's all relative. They might be willing to accept a lower return in exchange for that perceived stability of real estate.
So a widening yield spread isn't always a clear-cut positive sign. You really have to look at the big picture.
Right. Exactly. Context is everything. You've got to consider what else is going on in the economy and the financial markets. Now, on the flip side, a narrowing yield spread can be a little trickier to interpret.
How so?
Well, it could mean a couple of things. It could mean that investors are becoming more cautious about real estate.
Maybe they're worried about the economy slowing down or interest rates going up.
Right, exactly. Or it could simply mean that their preferences are shifting towards lower risk income-producing properties.
So even if the spread is shrinking, they might still be drawn to real estate for that steady cash flow.
Precisely. Especially if they're looking for a more predictable return in uncertain times. You know, Michael always says that real estate investing is as much about psychology as it is about numbers.
It's about understanding what's driving those numbers. Why are investors making the decisions they're making?
Absolutely. You have to get into their heads a little bit. And that's where experience and market knowledge really come into play. That's what Michael brings to the table.
So we've talked about how he uses yield spread to analyze properties, compare locations, and now gauge overall market sentiment. But how does he actually apply this knowledge to help his clients make decisions? What kind of advice does he give?
Well, one of the key things he emphasizes is using yield spread as a filter.
A filter? What do you mean?
Well, like if you're looking for properties with a lot of upside potential, a higher potential for growth, you might focus on areas where the yield spread is widening.
Because that suggests investors are bullish on those areas and willing to pay a premium.
Right. And on the flip side, if you're more interested in stable income-producing properties, you might look for areas where the yield spread is narrowing or at least staying pretty consistent.
Because that suggests a more stable market with less volatility.
Exactly. Those areas might not see the same rapid appreciation, but they can offer a more predictable return, which can be very appealing to some investors.
It's all about aligning your investment strategy with your risk tolerance and your overall financial goals.
Couldn't have said it better myself. And of course, financing plays a huge role in all of this. Michael always emphasizes that.
Right, because most real estate investments involve some level of borrowing. So how does yield spread factor into that side of the equation?
That's a great question, and it's something we'll delve into next. Stay tuned.
Okay, so let's talk financing. Most real estate deals involve borrowed money. So how does yield spread come into play when you're looking to finance an investment?
It's a huge factor. Michael always reminds his clients that lenders are basically investors too.
They are, yeah. They're putting up their money, and they expect a return, just like anyone else.
Exactly. They're constantly assessing risk and reward, just like any other investor, and yield spread is a key part of that equation.
Okay, so how does yield spread actually impact a lender's decision to finance a project?
Well, think of it this way. When the yield spread is wide, meaning real estate returns look really good compared to those safe government bonds.
Lenders are more likely to open up their wallets.
You got it. They might offer lower interest rates, better loan terms, and be willing to lend a higher percentage of the property's value. All that makes it easier and potentially more profitable for investors to leverage their investments.
So a wide yield spread basically creates a more favorable lending environment, making it easier to access capital and potentially boost those returns.
Precisely. But here's the flip side. When the yield spread starts to narrow, when that gap shrinks.
Lenders get a little more skittish, right?
Exactly. They might raise interest rates, shorten those loan terms, or demand bigger down payments. Suddenly, it becomes a lot more expensive and challenging to get financing for a project.
It's like the market sending a signal saying, hey, things might be cooling off a bit, so let's be a bit more cautious.
That's a great way to put it. It's like this ripple effect. Changes in yield spread can influence the entire lending landscape, which of course has a big impact on property values and investment decisions.
This all ties back to what we were talking about earlier, about how everything's interconnected in real estate. The yield spread, the lending environment, overall market sentiment, they all play off each other.
It's a complex web, for sure. And that brings us to a really interesting point Michael often makes about yield spread. It's not just about understanding the current market conditions, it can also give you a glimpse into the future.
Oh, so we can use it to kind of anticipate where the market's heading.
Yeah.
That's fascinating.
Yeah. It's not a crystal ball or anything, but when you analyze yield spread alongside other market indicators...
You could start to see patterns.
Exactly. You can get some valuable clues about potential trends.
So what are some of the things Michael looks for when he's trying to use yield spread to anticipate market shifts?
He pays a lot of attention to the direction and momentum of the yield spread trend.
So, like, is it widening quickly, narrowing sharply, or just kind of bouncing around within a range?
Right. Those rapid changes in yield spread can sometimes be an early warning sign of shifts in market sentiment and how investors are feeling.
So, for example, if that spread suddenly shoots upward, it could mean investors getting super bullish on real estate. Maybe that leads to a period of rapid price growth.
That's definitely a possibility. It could signal that investors are seeing real estate as a better bet than other asset classes, and that increased demand can push prices up.
And on the flip side, if the yield spread takes a nosedive, it could be a signal that things are cooling off, maybe even heading for a correction.
Right. It might suggest that investors are getting nervous, pulling back from real estate and looking for safer places to put their money.
It's almost like watching the tide come in and go out. A sudden surge or retreat can signal a change in the current, and investors need to be ready to ride those waves or seek shelter when necessary.
That's a great analogy, but it's super important to remember that yield spread is just one piece of the puzzle.
Right. There are always other factors at play.
Exactly. Michael always says you've got to look at interest rates, inflation, job growth, consumer confidence, all those things. It's about seeing the whole picture.
Not putting all your eggs in one basket, so to speak.
Precisely. Real estate is complex. It requires a holistic view, a strategy that takes all the relevant factors into account.
Well, this has been an incredibly eye-opening deep dive into the world of yield spread. We've learned what it is, how it's used to analyze properties, and even how to use it to try and predict future market movements. It's really amazing how much information is packed into this one little concept.
It really is. And I hope our listeners have a new appreciation for the power of yield spread and how it can help them navigate the real estate market.
I think they do. And a huge thank you to Michael Linton for sharing his expertise with us today. His deep knowledge of the Chicago market and his mastery of yield spread analysis have been invaluable.
His insights are always so practical and thought-provoking.
They are. And to all our listeners, thank you for joining us for another deep dive. We hope you found this episode informative and maybe even a little bit inspiring.
Definitely.
And don't forget to check out chicagodealflow.com for more great resources from Michael and his team. We'll see you next time on The Deep Dive.